If you are enrolling in or choosing Medicare supplement coverage, it can be very tempting to want to choose the cheapest plan available. But what if I told you that the price you pay today is only a very small part of choosing the correct Medicare supplement coverage? The cost of your Medicare supplement plan will increase as time passes. Let's look at why this happens, and we will also shed light to possibly the main reason behind Medicare supplement premium increases, and we will talk about how you can hopefully avoid choosing the wrong coverage and falling into the trap of rapidly increasing premiums like some of your peers. My name is Cameron Giardini, and over the last several years at Giardini Medicare, our independent Medicare-focused insurance agency, we have helped thousands of consumers enroll in different Medicare supplement plans with different insurance companies, and perhaps even more importantly, we have seen firsthand how the cost of these plans can drastically be different from one company to the other, which impacts the budgets of our clients for years to come, and even potentially forcing some to change to Medicare Advantage plans due to no longer being able to afford Medicare supplement premiums. As a reminder, Medicare supplement plans are insurance policies designed to fill in the gaps left by original Medicare, hence why they are often called Medigap plans. Original Medicare includes Part A for hospital insurance and Part B for medical insurance, but it does not cover 100% of out-of-pocket costs you may face. Now, quickly on the screen, you can see out-of-pocket costs like co-payments, co-insurance, and deductibles that you would be responsible for with just original Medicare. But that is where Medigap plans come into play. They help cover some or even all of the out-of-pocket costs you have seen on the screen, providing a safety net for unpredictable healthcare expenses during your retirement. Now keep in mind, in this video, we will often refer to Medicare supplements as Medigap plans, but again, we are talking about the exact same thing. Currently, there are 10 standardized Medigap plans, each labeled from a letter ranging from A to N, and each of these will offer a different level of coverage. Here's a chart from the official Medicare and You book that shows the different coverages provided by these different Medigap plan letters. Let's dive a bit deeper into the world of Medigap plans and talk about how the Medigap premiums work. This is a crucial aspect to understand as you consider whether a Medigap policy is right for you or not. Remember, a premium is simply the amount you pay per month to an insurance company to keep your coverage active. Think of this being similar to monthly premiums you pay with home or auto insurance. It's no different. Medigap premiums are in addition to and separate from what you would pay for Medicare Part B. So for example, if your Medigap premium is $130 per month and you still have to pay the base rate for Medicare Part B premium, which is $174.70 per month in 2024, you would pay these separately to different entities. You pay your Medicare Part B premium to the government, and your Medigap premium goes to the insurance company that is providing that coverage. So in this quick example, your monthly premium for both coverages would be $304.70 per month. Now, Medigap premiums will vary based on different factors. Not only will monthly premiums vary from one Medigap plan letter to another, like a Plan N versus a Plan G, but there will often be dozens of private insurance companies offering plans with the exact same plan letter. However, despite being the same plan letter and the same coverage, they would have different monthly premiums. For example, as of recording this video, in Metro Detroit, there are at least 40 different insurance companies offering a Medigap Plan N, all at different monthly premiums, and the same is true for Plan G. Two other significant factors are your location and your gender. Insurance companies, they may charge different premiums depending on the state or even the specific region within a state where you live. For example, a 65-year-old female in the Upper Peninsula of Michigan, they might pay $80 per month for a Medigap Plan N, while a 65-year-old male down in Detroit might pay $100 per month for a Plan N with the same coverage and even from the same exact insurance company. Now you might be wondering, just how much can these premiums actually vary nationwide? Well, here on the screen you can see a map we made to show what you might expect to pay for a Medigap Plan G for a 65-year-old male non-tobacco user in different states all across the country. And here is that same map, but with Plan N pricing instead. Also, please comment below if you want a rough estimate of Medigap pricing in your zip code. Please respond with your zip code, and then we will do our best to respond with a specific quote for that zip code. When you're considering Medigap coverage, it is essential to look at how the monthly premiums for each plan might vary based on where you live. I would encourage anyone watching this video to get in touch with an independent broker licensed in your state so you can get an actual realistic idea of your specific Medigap pricing before you get too caught up in other details. We will have a link below if you want to connect with a broker. However, what you pay when first beginning Medigap coverage, again, it's just a small piece of the puzzle like we mentioned in the beginning. So once you understand the current pricing for plans in your area, it is crucial to understand what factors will impact Medigap price increases going forward. Like any insurance product, a variety of factors can cause your Medigap premiums to increase. And regardless of what anyone might tell you, all Medigap plans are going to experience premium increases at some point. First, it is very important to grasp the overall concept of a loss ratio when it comes to Medigap plans. This is a term that insurance companies use to describe the balance between the premiums they collect from plan enrollees like yourself and the claims they pay out for medical care for those same enrollees. If an insurance company is paying a large amount of money in the form of claims compared to the money they are collecting as far as monthly premiums, the company will have a higher loss ratio. This is simply unsustainable for insurance companies, so a higher loss ratio is likely to lead to Medigap premium increases to bring things back into balance. When it comes to Medigap plans, they must have a loss ratio of at least 65%. Don't worry about remembering that exact number, but it's something you may want to know. What this means is that for every dollar they receive from members, they must spend at least 65 cents on those members' medical bills. Overall, most Medigap companies, they aim for about a 75 to an 80% loss ratio to remain profitable without having too many premium increases. You can even see here a chart that was filed by an actual insurance company with the Department of Insurance. This shows their loss ratios in the incurred claims column and other percentages that they have planned for expenses and profits. Now, we don't bring this concept up of loss ratios for you to try to scour the internet, trying to find a company with the absolute lowest loss ratio, or for you to get too caught up in the actual data. Instead, just understand behind the scenes, Medigap premium increases are in large part driven by the balance between monthly premiums a company collects versus the money they have to spend on medical claims. Think of it kind of like a bank. They need more money coming in than they're paying out to survive. Now, before moving on from loss ratios, it is also very important to understand that the loss ratio for a Medigap plan, it is impacted by the overall health of the entire group of policyholders with a specific plan letter in your state. So for example, if you are enrolled in a Medigap Plan N in Michigan, your Medigap premium increases, they depend on the healthcare claims of all members enrolled in that same Plan N with your same insurance company in your state. This is why choosing the right Medigap plan with the right company is so important. That's because if the group as a whole experiences more expensive or more frequent medical claims, the insurance company may need to increase premiums to maintain a balanced loss ratio. This means that although your individual medical claims will play a small role in the overall premium increase calculations, your Medigap plan, it can't target you as the individual and increase only your premiums if you have increased health needs and health issues. In addition to medical claims leading to Medigap premium increases, there are other factors that cause premium increases such as inflation. We're not going to get into detail about this topic, but you are all probably aware now that the cost of healthcare has risen due to inflation, and so too do the plan premiums to compensate for this increase. Let's move on from medical claims, loss ratios, and inflation. We will discuss another concept that impacts Medigap premium increases. Understanding how Medigap plans are priced or rated is another crucial step in choosing the right policy for you. Now, we aren't talking about star ratings like with Medicare Advantage plans, and we aren't talking about how many angry reviews they have on Google.
A bad review could ruin us.
But we are talking about the fact that Medigap plans are rated in 3 different methods. These are community rated, issue age rated, and attained age rated. Let's start with community rated plans. Using this system, according to Medicare.gov, generally the same monthly premium is charged to everyone who has the Medigap policy regardless of age. So whether you are enrolling in a plan at age 65 or age 85, your premium would be the same in that case. The main benefit of this system is that your premium, it may increase over time, but not because of your age. Here is a quick example of 2 people purchasing a community rated plan. We'll show Mr. Smith, who buys a Medigap Plan G at age 70 for $160 per month, while Mr. Jones, on the other hand, buys a Medigap Plan G from the same exact company at age 77, but he also pays $160 per month. Now, when each of them have have their next birthday, their premium, it won't increase due to their new age, but it still may increase and still probably will increase due to inflation and other factors like claims and the loss ratios we talked about. Next, we have issue age rated plans. In this system, your Medigap premium is based on the age you are when you buy or when you're issued your Medigap policy. It is not the same for everyone, regardless of age, like with community rating. The premiums with issue age plans, they may increase due to inflation and other factors, but not due simply to your age. Here again is an example of two people purchasing an issue age rated plan. Mr. Smith here buys a Medigap Plan G at age 65 for $140 per month, while Mr. Jones, on the other hand, buys a Medigap Plan G from the same exact company at age 73 for $180 per month. Notice in this case, the premiums are higher for Mr. Jones since he is older at the time of issue than Mr. Smith. When each of them have their birthday, their premiums, they won't increase due to their new age, but again, they will likely increase due to other factors like inflation, claims, and loss ratios. Now finally, we have attained age rated plans. In this system, your premium is based on your current age when you purchase your Medigap policy, and your premium will increase as you attain a new age, meaning your age increases. Here's an example of two people purchasing an attained age rated plan. We have Mr. Smith who enrolls in a Plan G at age 68 for $120 per month, and we have Mrs. Jones on the other hand who buys a Medigap Plan G from that same company at age 72 for $150 per month. Now, when each of them have their birthday or when they attain a new age, their premiums will likely increase due to them attaining a new age, as well as other factors like inflations, claims, and loss ratios. Real quick, leave us a comment below saying whether you prefer issue age, community rated, or attained age rated plans. Now for some added practical information from the perspective of a broker, know that many Medigap companies with an attained age policy, they don't always implement those age increases from about roughly age 65 to age 68, so they can keep premium increases a little bit lower during those first few years that most consumers are enrolled in the plan. Now once age increases do start being implemented, many companies will apply a yearly increase of about 2 to 4%, and that is in addition to the claims increases or inflation increases you might experience. Now that you are familiar with the different Medigap ratings, you might be tempted to go run out and get an issue age rated or a community rated policy to lock in those lower premium increases for as long as possible. But like with all things when it comes to Medicare, it's not that easy. First, every state will have differences when it comes to which type of rating system is most widely available. For example, we recently looked at Medigap plans in Michigan, and of 44 insurance companies offering Medigap plans, 41 of them are attained age policies. Now compare this to Idaho, where Medigap companies, they are now mandated to be sold as community rated plans, so all of the available plans are community rated. You can see here a map of the common Medigap rating system in each state, and we will link to this in the description below this video. Secondly, many people mistakenly think that issue age and community rated plans will never have premium increases as you get older, but that is simply not true. And you don't even have to believe me. If you read the definitions on Medicare.gov, you will see that their plan premiums may increase due to inflation and other factors. So although community or issue age rated plans, they might certainly have lower premium increases, they will still have increases over time. And as an example, using one of the few plans in Michigan that is issue age, here is a chart of their actual filed premium increases going back to 2013. This is for their Plan G, and they actually averaged a 2.9% increase per year. Now these increases, they're reasonable still, but they are not zero like a lot of people like to make it seem. And last but not least, issue age or community rated plans, they may have a higher initial premium compared to attained age plans, which might negate some of the premium savings with not having those age premium increases. Again, we'll use Michigan for an example, but it will vary by state. So in Detroit, the lowest attained age Plan G that is available for a 65-year-old is approximately $130 per month right now. Now compare this to one of the few issue age Plan Gs that are also available, and for that same 65-year-old, it would roughly be $180 per month for that same exact coverage. Now in this case, the lack of age increases might not be worth it due to the higher monthly premiums you're paying for the plan. If you've made it this far in the video, please comment below if you want to us to talk about any other topics or if you have any further questions of how Medigap plans increase. And now we're going to talk about the final factor and probably the most important factor when it comes to Medigap premium increases, and that is the topic of open blocks of business and closed blocks of business. This may also be called a book of business, but it's all the same thing. Now, don't worry too much about the terminology, but essentially, these blocks are just groups of plans that the insurance company sells. So as an example, let's pretend that insurance company X is selling Medigap Plan G in Ohio, and they call this specific Plan G the really awesome Plan G. Now, all of the consumers that enroll in that really awesome Plan G with company X in that state, they will be part of the same block of business. This is important to remember, so stick with us. This would be considered an open block of business because company X, they are actively selling really awesome Plan G policies to new enrollees. This means they are continually adding new policyholders or enrollees to the block of business. Closed blocks of business, on the other hand, they are no longer available for new policy sales. In other words, the block is closed to new enrollments, and no new policyholders are added to the group or enrolling in the plan. A real-world example will probably make this easier to understand, so we will show that right now. So let's say insurance company X releases their really awesome Plan G for $120 per month for a 65-year-old, which happens to be about the lowest in the market, and for that reason, it makes Mrs. Jenkins decide to enroll in that really awesome Plan G when she is 65. However, what happens is after a few years of rate increases due to the normal medical claims of everyone enrolled in that plan, and going back to that loss ratio concept we talked about earlier, the plan isn't as attractive to new enrollees. For example, now Mrs. Martinez is turning 65 and she wants to enroll in the same really awesome Plan G that her friend Mrs. Jenkins has. But when she goes to get a quote, the really awesome Plan G with company X is now $145 for Mrs. Martinez. Again, this is the same exact plan. However, now there are other companies still offering that Plan G for about $120 per month, just like company X was doing a few years ago. At this point, company X, they have a decision to make. The really awesome Plan G, it is no longer competitive and attractive in the market. And what happens is that people like Mrs. Martinez enroll in different Plan Gs with one of those insurance companies, still pricing their plan at $120 per month. They realize that Mrs. Martinez is not alone when it comes to this thinking, and soon company X finds that enrollments in that really awesome Plan G are drastically slowing down. Now at this point, company X, they can't simply lower the price of their really awesome Plan G because again, they have to meet certain loss ratios that we talked about earlier in the video to maintain profitability. So at this point, company X, they could let the plan continue to rise in price and do nothing about it, but they want to make money by getting new Medigap enrollees with their company. Now this is where closing and opening a block of business comes into play. So now company X closes their really awesome Plan G block of business to new enrollments, and they stop selling, they stop advertising the plan. Instead, company X, they decide to create a new block of business, which they call the super awesome Plan G. Now this is $120 per month, and it is competitive again with other plans on the market. But what about the people like Mrs. Jenkins who enrolled in that really awesome Plan G that is now closed? Now you might be thinking that she will simply just change to the new Plan G or go to a competitively priced plan with another company, but it is not that easy. Remember, in most states and in most circumstances, you have to qualify for a new Medigap plan based on both your health and pre-existing conditions. Now, contrary to popular belief, you can be denied enrollment into a Medigap plan based on your health. We have way more details about this in other videos, but here is a map of states that do have some more lenient rules when it comes to changing Medigap coverage. So now, the people enrolled in the closed, really awesome Plan G, they are going to get tired of the higher monthly premiums, and they will try to apply for new Medigap plans and leave that really awesome Plan G. However, this is only if they're healthy enough to qualify for a new Medigap plan. On the other hand, those with more health conditions, they might not be able to qualify for a new plan, so essentially they're stuck with that really awesome Plan G from company X. It doesn't feel as awesome anymore. This is exactly what Mrs. Jenkins experiences when she tries to change plans, but she cannot due to a recent cancer diagnosis. Now, this creates somewhat of a spiral of premium increases, since healthy people, they tend to leave the plan, leaving a higher percentage of people with health issues remaining. This drives up the overall percentage of medical claims, and ultimately it just forces more premium increases, which accelerates that vicious cycle. Now, the people harmed in this scenario, they are the ones that are not healthy enough to qualify for a new Medigap plan like Mrs. Jenkins. While Company X, on the other hand, they continue to sell new super awesome Plan Gs, and they're still profiting. It really does not affect the insurance company, unfortunately. In our opinion, the closing of Medigap blocks of business is one of, if not the most important factors when it comes to premium rate increases, and the data backs this up. Unsurprisingly, the monthly premiums of a Medigap plan in a closed block of business, they have risen much faster than those in an open block. Here is an actual example of rate increases filed by a Medigap insurance company in Michigan. Can you look at this and guess when they closed their book of business? Well, if you guessed 2019, you're correct. In addition to this example, we looked at the average Medigap premium increase data in Michigan and specifically focused on rate increases when a block of business was open versus after it was closed. Now, we took a look at 21 different insurance companies offering Medigap plans, and we found that the average amount of time a company had a block of business open was just about under 5 years until it ended up being closed. Here are the average rate increases associated with plans while they were considered an open block of business versus those same exact companies' average premium increases once those became closed blocks of business. We will of course link to our sources for this data in the description below this video. But what about the question you might have? How do you avoid enrolling in a company that may close their current Medigap block of business in the future? Unfortunately, you really can't. Despite what anyone might tell you, given enough time, essentially all insurance companies offering a Medigap plan will close a current block of business in favor of a new one. However, there are some that are more likely to do so, which is why you should always consult with an experienced broker familiar with companies in your area to discuss the trends they have seen with their own clients to give you perhaps the best shot at avoiding falling into this trap. Although you need to understand that even the most experienced broker with all of the data at their fingertips still will not have that crystal ball to accurately predict what an insurance company is going to do in the future. Up to this point, we have talked a lot about different factors impacting Medigap premium increases, but the key to remember is that when it comes to choosing a Medigap plan, it's vital to think long term. These plans, they should not be considered short-term coverage decisions, but rather they are meant to provide stable, reliable health insurance coverage for you as you age. Choosing a plan just based on the lowest initial premium, it might end up costing you more in the long run if the premium rates increase dramatically over time or if the block of business you are in closes sooner than expected. Here are a couple tips for finding a Medigap plan that can hopefully serve you for the future. First, consider the company's reputation and financial stability. Established companies with a history of financial strength and a large amount of enrollees, they are able to spread out and absorb the risk for more reasonable premium increases over time. Secondly, look at the history of the rate increases for the actual Medigap insurance company you're considering, as well as their history of opening and closing blocks of business. While past performance does not always guarantee future results, it can give you a great sense of how that company manages its plans. Again, choosing a Medigap plan, it is not just about understanding the landscape of Medicare supplements, but it's also about understanding your personal health needs and your financial situation. Do not hesitate to get help finding a reliable Medigap company that will be there for you in the years to come.